Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Marc Rowan, CEO of Apollo. Marc, nice to see you. Thanks for joining us.
Thanks for having me.
So you recently talked about the old tailwinds being over. There's some headwinds, but there's some new tailwinds. Talk to us about what's going on right now in the marketplace that helps out Apollo.
So I'd say this. I don't know that we have new tailwinds. I think we have structural shifts going on in the market. And I think we have signposts of things we should try and interpret. One is we've seen a market that's become increasingly concentrated and indexed and correlated. That has made more and more of what's in the public markets beta. And to the extent investors want alpha, and most investors do, they have had to step outside of public markets into private markets.
You're talking about stocks like the Mag 7 and everyone just being indexed to that, basically.
Well, I'm talking about the bond market as well. I'm talking about access to assets like real estate, like infrastructure, and other types of things. We also have this rethinking in the world going on. We grew up as investors thinking that private was risky and public was safe. And we know that in our bones. But what if that's not true anymore? 40 years ago, private was three products: private equity, venture capital, and hedge funds. All can be good investments, but all have risk. And public were 8,000 public companies, diversified portfolios of stocks and bonds. 40 years later, I think we now know public, safe and risky, private, safe and risky. Investors are increasingly coming to private markets not just for return, they're coming for diversification. And so what started as a business that was funded out of the institutional investor bucket called alternatives, because when something is private and risky, you put it in a little bucket. You call that bucket alternatives. You want to watch it very carefully. All of a sudden, we have this second market called individuals. Individuals are realizing that they can realize the same benefit from private markets that institutions can, and they're not going to take 40 years to get there. We now have a third market, which is retirement insurance companies. People have seen what we have done by accessing private investment grade, and others are doing it. We now have a fourth market. We have traditional asset managers who are following what BlackRock did last year and rethinking how they provide alpha to their clients in traditional products. Maybe the new form of active management is not the buying and selling of stocks and bonds, but the addition of private markets to public beta portfolios. In short, it's a really interesting time in our business.
And that's leaving aside macro stuff. We'll get to that. But why?
Oh, that's right. That's right. There's macro too.
Why are privates and alternatives? I saw you said that not the same thing.
Because we have a definition of alternative as something that is supercharged, that is highly levered or highly speculative, looking for really high rates of return. I think what we've realized over time is that private is safe and risky. Private goes from AA to levered equity and venture capital, just like public goes from AA to levered equity and risky equity. And increasingly, we started with a view of private just belonging in the alternative bucket. Now we have an ETF, which is public and private investment grade, tradable every single day, priced every single day. And we have everything in between. And so I use the term private to describe access to private markets, and I use the term alternative to refer to a more classic or traditional definition of the riskier end of private markets.
Right. And all this is allowing you and affording you the ability to play offense instead of defense. I know you've talked about that. Talk to us about Apollo, though, a little bit. I think you could argue that it's a little complicated. Say you were in Hollywood. You're talking to a Hollywood producer. You want to
get elevator pitch?
The elevator pitch. 2 minutes. Apollo, the movie. What is it? Why should I make this film?
Two businesses. Retirement services fed by an aging population and the need for income. Second, an asset manager who services both the retirement services company and other investors. You come to us for excess return per unit of risk, a philosophy of purchase price matters, and because we're aligned with you. We are half of everything we do.
All right, all I need is to figure out who's going to play you in the film.
Well, hopefully someone really good looking.
Yeah, there you go. And talk to us a little bit about Athene, which is your insurance business. What are the opportunities? People sometimes talk about the risk there, though, as well. Speak to that, please.
So Athene is a retirement services insurance company. We started Athene from scratch in 2008, 2009. It, along with its European affiliate, are now more than 400 billion of assets under management. We grow on a gross basis more than $70 billion a year. So we're doing something right. We are, in fact, the largest provider of retirement services products to the U.S. market by a long shot. How did we get there? Well, if you think about what the business is we earn money on the assets we hold, less our cost of liabilities, less our cost of operations is net spread. We've earned a good ROE for the past 17 years of north of 15%. So it's a good business for us. But it's also a good business for policyholders. What happened is we were successful because we were able to generate higher returns off investment-grade assets, so-called private investment grade. We kept some of that excess return for ourselves, thus the higher ROE, but we gave some of that excess return to policyholders in the form of benefits. And guess what? It turns out that people prefer more to less. It is no more complicated than that. That has allowed us to hold on to capital for the past 17 years versus paying it out as dividends. We now have accrued the second largest capital base in the U.S. market. We've raised roughly 40% of all the money raised in insurance in the U.S. and Europe for the past 15 years. We've steadily climbed from a rating point of view, where not only high investment grade across all agencies, but hold AA or AAA capital under some rating agency methodology. And we've just gotten better and better. But fundamentally, this business is driven by people getting older, which includes the two of us, and the need for retirement income.
Speaking of retirees, Mark, and retail investors writ large, there's sort of two schools of thought when it comes to broadening out their exposure to privates or alternatives. One is, wow, it's great to let them share in this great asset class. That's vision number one. Vision number two is, boy, just when the institutional markets are saturated, the private equity guys are selling this risky stuff to these poor mom and pops, Joe public people out there. Which one's true?
Kind of neither. It's not really how the business is run. First, I think of the private markets, individuals, as a pyramid. At the top of that pyramid are family offices. Family offices are just small institutions. In some cases, they're large institutions. They are sophisticated. They are capable of diversification. They're capable of evaluating risk-reward. They should, in my opinion, have access to every investment opportunity, including those that are risky, along with those that are safer. The next level down is high net worth. High net worth has lots of definitions. For me, it is a client who is worth advising, not necessarily by us, but by a wealth system, by an RIA, or by some form. Those clients have not historically had access to private markets. They are now, for the first time, getting access to private markets, and the vast, vast majority is focused on yield. It is yield from credit, it is yield from real estate, it is yield from infrastructure, with little bits of access to equity, sometimes private equity, mostly not. When you move down to the mass of investors, the vast majority of people, I do not believe that they are going to access private markets directly or through firms like ours. I believe that they will access private markets through their traditional asset manager, and I believe traditional asset managers will actually be very big users of private. Every mutual fund has a private bucket. ETFs combining public and private. I don't think most investors will have private products. I think they will have private assets in wrappers like funds and ETFs that they understand. As to the comment on private equity has always been, as levered equity, a riskier asset class. Now, over a long period of time, it has produced good returns. And sometimes some vintages are better, some vintages are worse. But I don't think it is that product, those funds that are being sold to individuals. I think individuals in many ways are the beneficiaries of new funds and new portfolios going forward.
Let me shift gears and ask you a little bit about Apollo stock. Over the past 1 year, 3 year, 5 years, you guys have outperformed the market and your peer group, the other publicly traded alternative asset managers. And basically, you and KKR have been the two leading stocks. Your stock has underperformed the market along with the peer group over the past, year to date. Why is that?
More sellers than buyers.
Thank you.
I don't know that
Please elaborate.
I don't know that there's a fundamental reason. as to why our stock has, in a short period of time, underperformed or
Well,
otherwise.
what's the problem with the sector versus the market then right now?
I don't think it's a problem of sector. I think that these stocks have had a very good run. We went from something that was not well understood by the market to something that is better understood by the market. And we were perceived as a group as having more exposure to business cycle. I think people are in the process of rethinking that. I like where we sit as a business driven by fundamental trends. At the top of the house, the fundamental trends are retirees, need for income, and what we're building here. Because financing comes from only two sources. It comes from the banking system or the investment marketplace. The banking system is really good at doing some things, short-term, highly rated. The bond market is really good at simple. But think about what we're building. We're building semiconductor plants. We're building infrastructure. We're doing next-generation data and power. We're redoing our electric grid. We're doing defense. All of these things are long-dated and complex. They will need to be financed. Some of that financing will be debt, so-called private credit, even if it's investment grade. Some of it will be the need for equity, either common equity or hybrid or preferred equity. And so the scale of what is needed versus the size of what the whole industry is actually quite small. I look at that in acceptance. We started as only owned in the alternative bucket of institutions, broadened to individuals, broadened to retirement services companies, broadening now not just to traditional asset managers, but broadening to the fixed income bucket of institutions as people rethink whether investment grade private and investment grade public belong side by side. Should they be converged? Should we just look at investment grade versus thinking about public and private? So lots of demand for product, lots of need for supply of product. Our job as an industry, and I think our success or failure as an industry, are we good investors? Are we good stewards of credit? Ultimately, our business exists to produce excess return per unit of risk. If we do that, we win. If we fail to do that and become marketing machines, we lose.
So therefore, why should an investor buy Apollo stock right now? I mean, I saw that you guys increased your cash dividend, you did a share repurchase recently. What are you doing to drive the stock so that investors benefit, specifically, Marc?
We're capturing these trends. We have positioned the business squarely in the trends that I've described. When it comes to retirement and the need for income, we are Athene, the largest of its kind. When it comes to the financing of the demands of the economy that are taking place now, we are the largest provider of private investment grade. Mm-hmm. And we have set ourselves up around the notion that origination, the origination of good risk, excess return per unit of risk, is the key. We've been making investments for more than 15 years in this area. Some 4,000 people work at Apollo who don't carry an Apollo business card, but wake up every day just originating capital for us to invest in. And the trends and things we've been speaking about for the past 5 years, we're watching play out, whether it is BlackRock buying 3 private markets firms, or it is the announcements across our industry. I think this is among the most exciting times to be in our industry. Oh, and we haven't talked about macro yet.
We'll get there. But first I want to ask you a couple governance questions. You own what, about 6% of the firm's equity worth, what, say, $5 billion? Are you aligned with shareholders, therefore? Do you really care if the stock goes up if you have that big a stake?
Well, I think that's the definition of caring. But I care over a really long period of time. I've owned the stock for a long time. I will own the stock for a very long period of time. And it's not just me. Throughout our management structure, there's a heavy dependence on equity performance over a long period of time. And it's the philosophy by which we run the entirety of our business. Not just on the equity side. When you look at an asset manager with some $800 billion of assets under management, $400 billion is our own balance sheet. Mm-hmm. That means we are aligned with investors like no one else. And therefore, they will have the same outcome that we have. I like that from an employee point of view. I like that from a management point of view. Let's make good long-term decisions. We're in a good market, in a good industry, with a good position, with great people.
Second governance question. You recently became chairman in addition to CEO, and Gary Cohn was named lead outside director. What are we to make of those two moves?
Well, I think you're missing the key third player. We had an excellent chairman who I miss a lot, named Jay Clayton.
Yes. Okay.
Jay went back into public service for his second stint. His office, a few down from me, was empty. Gary seemed like the perfect fit and became lead independent director. I stepped up to chair, which, as you know, is not a compensated role, nor a role I necessarily wanted in addition to, but it was really Jay's absence.
All right, so we're transitioning to D.C., maybe with the Jay Clayton comment. And I think that you said recently that we've done damage to the U.S. brand, the brand for stability, predictability, regularity. I see us moving from what was hyper-exceptionalism to merely exceptional. What does that mean?
So I think, look, my own belief, and I'm sure people will have different points of view, I think the administration's instincts as to what they want to do are right in so many ways. The notion that they should want to reset our trade relations with the world, I believe to be the right notion. And to do it when we have a position of strength, 4% unemployment, massive investment going in our economy, and all the things I spoke about. This feels like a good time to do it. I took issue with the basis on which we did it, or the specifics of how we did it, but that's neither here nor there. We've done what we've done. My observation is tariffs, and the way we rolled out tariffs, created uncertainty. Uncertainty in the short term, which has led people to hold back on investments, hold back on hiring, and as a result, we could end up with a recession, just a quarter or two of negative growth. Do I think we will have a recession associated with large increases in unemployment? No, I don't. Remember, we're starting from a position of strength. We're starting from 4% unemployment. But we were on such a good roll that it was not clear to me that this was advisable, no matter how lofty the goal. Longer term, I do worry that we have undermined our brand for financial stability, for understanding financial markets and welcome, because for the past 15 years, we've been winning. If you're an investor outside the U.S., you have three choices. You can go to China, you can go to Europe, or come to the U.S. For the last period of time, you've come to the U.S. That money flooded into our markets. It's part of the reason we saw our indices go to record highs. We saw 10 stocks become 40% of the S&P. We had at one point a 60 PE on those 10 stocks. We had one stock which was larger than the market cap of every stock exchange in the world other than Japan. That was not necessarily fundamentals. That was money flow. Now we've seen it go in reverse. We've seen some of that money leave the U.S., look for a better home. We've seen people on the margin saying, boy, I have a lot of exposure to the U.S. How do I reduce my exposure? The reality is the U.S. is the best market in town. We are still 60% of the world's capital flow. We will be for a very long time. But some of that hyper-exceptionalism, money just flowing in without question, I think is raising questions now.
I want to ask you a little bit about universities and the Trump administration. You were vocal about leadership at the University of Pennsylvania, your alma mater, led to the board chair and the president resigning. I'm wondering how you feel about what's going on at Penn specifically right now, and then also how you feel about what the university has been, how the actions they've been taking against universities.
So I'll say it this way. The universities have brought this on themselves. Imagine sitting in a seat in D.C. where a core group of universities is bragging about the size of their endowment and how few students they admit. That does not sound like a great marketing campaign, not to mention that 95% of faculty and administrators come from one political party and all the events that you've indirectly referred to that happened on campus. The point I would make is I think things have stopped swinging to the negative. I think universities have gotten the message that perhaps it's time for a fundamental rethink of what they do and how they're run and their purpose. But universities are not corporations. There is not an easy means of governance by which these places can reform. There are lots of competing interests, not to mention lots of political and other interests. The administration has so far gone after reform. But in my opinion, a settlement with Columbia and a lawsuit with Harvard are not going to result in systemic reform. I believe the administration has captured universities' attention. I believe it has all the leverage that it needs to fundamentally reform the system, but I start by a belief that universities and colleges in the U.S. are a fundamental strategic advantage, and we should want them to be exceptional and to win. But yes, we should want reform, and I think the administration is in a position to get wholesale reform, and I hope they take the opportunity to do it.
You've said, Mark, that you've worked with some ethically challenged individuals at a predecessor firm, some maybe even at Apollo, one individual. What have you taken away from that behavior when it comes to your leadership, and how do you impart that in terms of values and culture at Apollo today?
We're in a trust business, and trust is pretty easy to destroy. We have to be really, really careful of how we conduct ourselves, and the decisions we make are really, really important. And so we model the behavior we want. We try to make sure that difficult decisions have an airing, that they're not made in secret, that we try and educate the next generation as to how to make these kinds of decisions under pressure, because it's not always an easy business. But reputation, reputation, reputation. And we're working really hard at it every day.
Let me ask you about the brand of Marc Rowan, which is to say, the sweater you wear is kind of a trademark look. And a lot of other Wall Street CEOs wear the suit and tie all day. How did you come to make that decision? What do you think that says about you?
I don't know that I made the decision. I've been dressing like this for the better part of 25 or 30 years. It's just no one cared until I became CEO. But I did a panel with another CEO the other day, and he said to me as we were getting ready, he goes, "Do you think I could carry the sweater look?" And I looked at him, I was like, nah, no chance.
That's a hard thing to transition to, I guess, once you're in the seat, right?
It's a hard thing to transition to once you're in the seat, had it not already been authentically who I am and what I do. But if you are my regulator anywhere, or if you are elected to national office and I am visiting you in your office, I show up in a suit and tie. I have them. I had to buy new ties recently, and I came in with the one I had, and I said, "I'd like something like this." And the gentleman in the store said to me, "They no longer make them that wide. You clearly have not purchased a tie in a very long time." So for better or worse, this is where I've landed. Most of our clients are actually casual. Most offices are casual. There are still a few industries and a few countries where that's not the case. But who's not happier in a sweater?
Hear you. And final question, Mark, what advice would you give to young people who are looking to start out going to Wall Street and want to have a long-standing career like yourself?
It's funny because I speak to students almost every day. And what's interesting is I think they're still focused on the past. Everyone says, "How do I get into private equity?" And I point out to them that for Apollo, private equity, massively important, but $100 billion of an $800 billion business. So many people have not opened their eyes, and so my advice to them is do the job that's in front of you and be a master of your craft. You have no idea where you're going to go in your career. Whatever you think, some other opportunity is going to come along the way, and you want expertise. And the second, don't be defensive, be curious. You've learned very little by speaking and a lot by asking people who disagree with you why they disagree with you. You may still stick to your guns, but you may actually hear something that'll change your mind. It's the advice I was given, and early on mastered my craft, and I do my best to not be defensive, but to be curious as to why people think the way they think.
Great. Marc Rowan, CEO of Apollo, thank you so much for joining us.
Thank you for having me. Appreciate it.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.